Silver markets are sending shockwaves through the global financial system tonight as prices, inventories, and supply chains move in ways that defy modern precedent and challenge long-held assumptions about how precious metals trade. Good evening. We begin tonight with a dramatic development in global precious metals markets, centered on unprecedented price movements in silver and significant disruptions across international supply chains. According to a market update recorded on January 29, 2026, silver has reached record price levels in multiple regions at the same time, while major refiners and mints have suspended new orders and exchange vault inventories have reported sharp declines. The information presented describes conditions that have not been observed in modern market history, involving price dislocations between Western and Asian markets, halted refining capacity, and accelerated physical withdrawals from exchange systems. The update states that silver prices in Western markets moved above $120 per ounce, marking a new all-time high. At the same time, silver on the Shanghai Futures Exchange reportedly surged to 31,099 yuan per kilogram, which is equivalent to approximately $139 per ounce. This created a price difference of about $21 per ounce between silver trading in Shanghai and silver trading in New York. The report emphasizes that this gap is unusually large and has persisted despite conditions that would normally allow traders to exploit such differences through arbitrage. The information further states that two of the world's largest silver refiners, the Perth Mint and Metalor, are no longer accepting new silver orders. According to the report, both institutions have halted intake entirely. In addition, Argor Heraeus and Nader are described as facing severe order backlogs, with delivery timelines reportedly extending into April and May. The update also references statements from Bullion Star, indicating that the company is actively searching for remaining available silver supply in the market. Wholesale silver premiums are said to have increased by between 100 and 200% within a 48-hour period. The report highlights that these developments are occurring alongside notable activity in Chinese exchange vaults. According to the Shanghai Gold Exchange daily report dated January 29, 2026, silver closed at 30,891 yuan per kilogram, reflecting an increase of 8.51% in a single trading session. Using the conversion provided, that closing price is said to equal approximately $138.25 per ounce. Gold prices were also reported to have risen sharply, with gold on the Shanghai Futures Exchange closing at 1,249.12 yuan per gram, equivalent to $5,590.20 per ounce, an increase of 7.88% on the day. Particular attention is drawn to inventory data from the Shanghai Futures Exchange. The update states that silver vault holdings fell by 26,360 kilograms in a single day. That amount is described as 26.36 metric tons, representing a decline of approximately 5.2% of total vault inventory overnight. The report compares this figure to the weekly silver vault report from January 19th through January 23rd, which showed a total drawdown of 1,530 kilograms over 5 days. The single-day decline is characterized as roughly 17 times the prior weekly rate. The update frames these movements as evidence of physical silver being removed from exchange systems at an accelerating pace. It states that these changes are occurring while paper markets are struggling to reflect the same conditions. The information presented characterizes the situation as a divergence between physical and paper markets, suggesting that price signals are no longer aligned across regions or instruments. The reported $21 premium between Shanghai and New York is described in the update as inconsistent with normal market function. Under standard conditions, the report explains, such a price gap would be expected to close rapidly through arbitrage, with traders purchasing silver in the lower-priced market and selling it in the higher-priced market. The update states that this process is not occurring and attributes the lack of arbitrage to the inability to move sufficient quantities of physical metal. According to the report, the price premium in Shanghai reflects the higher value placed on immediate physical delivery, compared to paper-based contracts. The update also references technical price behavior. It states that silver has moved beyond its previous all-time high, consolidated, and entered what is described as price discovery, trading above all historical resistance levels. The information cites volume data indicating significant accumulation in the $90 to $100 range, which is characterized as suggesting participation by institutional or sovereign buyers. The 21-day moving average is reported at $97, described as providing dynamic support at levels significantly higher than those seen 6 months earlier. Alongside these observations, the update outlines a series of risks that are presented as factors that could potentially slow or reverse current price movements. These risks are introduced within the report itself and include historical precedent for increased margin requirements by exchanges, potential intervention by Western central banks through coordinated actions, the possibility of sharp reversals following rapid price increases, regulatory actions that could affect cross-border pricing, algorithmic trading shifts, and limited transparency regarding warehouse and vault inventories in Western markets. These points are presented as considerations rather than forecasts. The report then contrasts those risks with what it describes as strengthening conditions supporting the current market structure. It states that the simultaneous halting of new orders by the Perth Mint and Metalor is not characterized as a temporary logistical issue. The update emphasizes that these are long-established institutions with extensive supply networks and that concurrent suspensions are presented as evidence of a deeper disruption in the supply chain. Delivery delays of 3 to 4 months from European refiners are cited as further indication of constrained availability. According to the information provided, mine supply is described as largely fixed in the short term, with primary silver mines requiring several years to move from discovery to production. The update notes that much of global silver output is produced as a byproduct of other metals, limiting near-term responsiveness to price increases. Within this context, the reported one-day withdrawal of 26 metric tons from Shanghai vaults is described as physical offtake by large buyers removing metal from the exchange system. The update also references data from the Silver Institute stating that global industrial silver demand reached new records in 2024 and 2025, driven largely by photovoltaic solar panel production. China's solar capacity installations are described as requiring hundreds of millions of ounces of silver annually, with that silver remaining embedded in infrastructure for decades. These developments are presented alongside broader movements in gold prices, which are described as reinforcing a wider trend across precious metals. The update characterizes the simultaneous rise in gold and silver prices, combined with vault drawdowns and refining halts, as signaling changing conditions in currency and commodity markets. Continuing our coverage, we now move deeper into the detailed sequence of developments outlined in the report, focusing on how current price behavior, supply disruptions, and exchange activity are being presented together as part of the same unfolding situation. The update emphasizes that the scale and speed of recent movements are central to understanding why the current conditions are being described as unprecedented within modern recorded market history. The report revisits the significance of the price gap between Western silver markets and the Shanghai Futures Exchange. It reiterates that a sustained premium of approximately $21 per ounce between New York and Shanghai is not consistent with a normally functioning global commodities market. In typical circumstances, such a difference would invite immediate arbitrage activity. Traders would be expected to purchase silver in the lower-priced market, transport or transfer it to the higher-priced market, and sell it for a profit, quickly narrowing the spread. According to the update, this process has not taken place, and the premium has remained in place despite its size. The explanation offered centers on the availability of physical silver. The report states that the metal required to carry out this arbitrage is not moving in sufficient quantity. As a result, the higher price in Shanghai is portrayed not as speculative excess, but as a reflection of the value placed on immediate physical delivery. The update explicitly contrasts this with paper-based silver instruments, suggesting that the market is assigning a materially different valuation to physical metal versus contractual claims. The update then shifts attention back to institutional and technical indicators that are said to reinforce this view. Silver's move beyond its prior all-time high is described as having occurred first through a breakout, followed by consolidation, and then entry into a phase where prices are no longer constrained by historical resistance levels. This behavior is presented as confirmation of what the report describes as strong underlying demand. Volume data cited in the update points to accumulation in the $90 to $100 range, which is characterized as activity consistent with large-scale buyers rather than short-term retail participation. The 21-day moving average is again referenced as sitting near $97, serving as a technical support level well above prices that were considered extreme only months earlier. The update frames this not as predictive analysis, but as contextual data that aligns with the broader supply and demand conditions being described. At this point in the report, the tone shifts toward risk acknowledgement. The update lists several factors that are presented as legitimate risks capable of altering current market momentum. One of the first risks mentioned is the possibility of higher margin requirements imposed by the CME or COMEX. The report references historical precedent from 2011, when silver prices approached $49 per ounce and margin requirements were increased multiple times in a short period, contributing to a sharp price decline. Additional risks outlined include potential coordinated intervention by Western central banks, possibly through swap lines or emergency leasing arrangements, though no such actions are stated as having occurred. The report also raises the possibility that the recent move could represent a blow-off top, noting that rapid parabolic price increases have historically been followed by violent reversals that remove a large portion of recent market participants. Further risks identified in the update include the potential for Chinese authorities to implement capital controls that could narrow the Shanghai premium, the role of algorithmic trading in amplifying price movements, and the lack of full transparency regarding inventory levels at COMEX warehouses and LBMA vaults. The report states that off-market supplies could exist, and if released, could alter near-term dynamics. These factors are presented collectively as reasons for caution, rather than as predictions. After outlining these risks, the update returns to what it describes as the strengthening bullish case, based strictly on observable developments. Central to this argument is the simultaneous suspension of new orders by the Perth Mint and Metalor. The report emphasizes that these institutions are long-established refiners with deep supply relationships. According to the update, their decision to halt new orders at the same time is characterized as evidence of a structural issue within the supply chain rather than a temporary logistical disruption. The report reinforces this point by citing statements from Bullion Star, which indicate that wholesale premiums have increased between 100 and 200% in a matter of days. This is described not as a short-term squeeze, but as a repricing of physical silver relative to paper contracts. Delivery delays extending into April and May from Argor Herias and Nadir are highlighted as further confirmation that refined silver availability is constrained at the highest levels of the supply chain. The update then addresses silver mine supply. It states that mine production is largely inelastic in the short term. Primary silver mines are described as requiring 5 to 10 years to progress from discovery to production. In addition, the report notes that a significant portion of global silver output is produced as a byproduct of copper, lead, and zinc mining, limiting the ability of higher prices to quickly increase supply. Within this framework, the Shanghai Vault drawdown is presented as particularly significant. The removal of 26 metric tons of silver in a single day is described as physical offtake, not speculative trading. The report states that such withdrawals are consistent with manufacturers, sovereign entities, or large institutions taking delivery and removing metal from the exchange system. The update further contextualizes this activity by referencing data from the Silver Institute, which is said to show record global industrial silver demand in 2024 and 2025. Photovoltaic solar panel production is identified as a primary driver of this demand. China's solar installations are described as requiring hundreds of millions of ounces of silver each year, with that silver remaining embedded in infrastructure for decades rather than returning to the market. The report then broadens the lens to include gold, noting that gold prices on the Shanghai Futures Exchange rose nearly 8% in the same session. This parallel movement is presented as reinforcing the idea that recent developments are not isolated to silver alone. Instead, the update frames the situation as affecting precious metals more broadly, with simultaneous price increases, vault drawdowns, and supply disruptions occurring at the same time. The report also notes China's role in global refining capacity and references recent export controls on certain critical minerals, including specific silver compounds used in electronics and defense applications. Within the context of the update, rising domestic prices alongside export restrictions are presented as part of the same set of observable facts, without additional interpretation beyond what is stated. As this situation continues to unfold, the report emphasizes that the convergence of record prices, persistent market dislocations, halted refining capacity, and accelerating physical withdrawals is what distinguishes the current moment from previous cycles. These are the conditions being described as unprecedented, not because of any single data point, but because of their simultaneous occurrence across price, supply, and inventory systems. If you found this breakdown valuable, share your thoughts below, stay engaged with the conversation, and follow along for continued updates as this developing story evolves.